Let's get started. Part 2 topics. I'm going to go over basically this list of topics. I'm going to give you a definition of cost element. I used the term earlier of direct and indirect costs. I'm going to go in a little more detail on that. The next thing I'm going to talk about are what we call indirect rates and overhead pools. These are groups of cost that are basically put in these pools or buckets of fringe, overhead, and G&A. And in order to price accurately, in order to make sure that you're bidding in a manner that your government customer intends to be having you bid, and able to compare to other contractors or to compare to your own information year over year, you need to understand these indirect costs of fringe, overhead, and G&A. So we'll go into that. I'm also going to give you the math of how indirect rates are calculated. There are certain methodologies. This number is the denominator. This number is the numerator. Very mathy on that session. And I'll give you some examples. And I'll also point out that there are different ways to calculate indirect rates, but these are the main ones, and there's a couple of variations. I also want to show you what a typical government contractor income statement or profit and loss looks like. Income statement and profit and loss are the same thing. It just happens that QuickBooks calls it a profit and loss, and the industry tends to call it an income statement. That shows how much your revenue is, how much you billed for the time period, usually a year, what your costs are, and whatever's left over is your profit. So I can look at somebody's income statement if they'll send it to me and immediately tell them if I think they've already failed their DCA audit. So that's why you want to pay attention here. I also want to point out that indirect rates are like taxes. So look at it this way. If I could buy a car in the boonies where their overhead is low, their cost is low, that's like less tax I'm paying in the purchase of that car. If I go into downtown Atlanta to buy my new Honda and they've got the showroom, they're giving me, they're making sure that I have all these extra things, a glossy showroom, fancy interaction with the salespeople, that's going to be higher price because I'm basically choosing to pay the tax of paying a higher rate by going to downtown Atlanta. Indirect rates are the same kind of thing. When you're competing on government contracts, you better make sure that your price is as low as you can reasonably be, or else you're just going to lose. That's just the bottom line, and we all know it. They'll say it's not about price. They'll say it's about best value. That may be somewhat true, but in the end, you got to give them a good reason to pay more for what you're offering. And a lot of times the government people on the other end don't have that choice. They've been told how they have to evaluate it. And there's no things that they can intervene on that would make it so that they could pick you instead if your price is not right. I want to give you a good idea of the percentage ranges for indirect rates of fringe, overhead, and G&A, because if you start doing pricing and you tell me your G&A rate is 60%, I'm just going to laugh and say, sorry, but you're already out of the game because a G&A rate should not be any more. It should be like 8 to 15%. So if it's 60%, you're never going to succeed in government contracting because your costs are too high. It could be that you'll outgrow that, but if you don't understand that that's too high for you to bid, you're not going to win. The last thing we'll talk about is calculating what's called your multiplier or wrap rate. And that really is a way that you say, if I'm paying Susan $50 an hour, what rate do I bill the government? That's going to be a multiplier or wrap rate. The second way would be is, oh my gosh, well, listen, I've looked at some history on this contract and did some research, talked to some other people that were involved in it, and they told me that the billing rate that I can probably charge on this contract is $72 an hour. So my question is, how much can I afford to pay the person to perform on that contract? So those are the part 2 topics. So let me go on to the next slide and let's get started. Definition of cost element. So cost element is kind of a government contracty term that's been around for a long time. Sometimes they'll call them other things, but a cost element means a type of cost. I've already mentioned we have direct cost and indirect cost. Well, how do you define a direct cost? It's got to be specifically identifiable to the contract. When I spend that expense, when I assign that person on their timesheet to go perform this work, they are specifically working for that customer on the activity that we're under contract to provide, specifically identifiable to a contract. The second, it's required for the performance of the contract. Well, required for the performance is mainly going to be it's labor for the contract. It's a travel or a trip that they're required to go do a travel expense to a different location, specifically because they were directed by the contract. It's identified usually in the proposal as direct cost. When you do the bids, they'll normally have a section of your pricing that'll say how many hours, what pay rates, and they'll have columns on top of that for what are your indirect costs, or sometimes they'll call them burdens. They call them different things. And they'll be identified what is your direct cost, which is the person's pay rate, times the number of hours you bid. And many times you don't have any travel that you bid, so it's not identified in the proposal, which means you can't travel unless you go back to your customer and say, hey, I need a modification or something like this, if you want me to spend that. And they'll go, no, we really don't want you going on trips. We're going to do it a different way. And it's typically billable to the contract and to the customer, meaning you can look at the contract and say, hey, it's called out here that I'm allowed to do this. And when I proposed it, they knew about it. So it's not a surprise that it's being billed at this point. So that's that whole category of direct cost. Yesterday, I gave an example of taking my Honda CR-V in to get the seats fixed because they wouldn't lay down flat and I couldn't fit my bike in the back. And I gave the example when I drive in to the Honda place, they've got 3 bays, the doors are open, I go park inside there, go inside, hand off the keys, and I talk to the customer service rep. He's an indirect cost. That means he deals with different people all day long, not specifically with one car, whereas the mechanic that does the service on my car and the part that I had to order to put in my car is a direct cost because it's identified to Jenny's car. So same thing deals with government contracts. And when you're getting confused or having these questions in your head, just think about taking your car to be fixed someplace. And what is the cost of getting your car repaired? And what is the extra stuff? The fact they've got a facility, they've got systems to support it. They've got a parts guy in the back. They got all this inventory, all the branding they do. That's all indirect cost. So let's keep talking about indirect cost. In the government contracting world, there are indirect costs or anything that these are shared costs that apply to multiple contracts or activities. They can't be identified to a specific contract. There's 3 main categories. One is fringe, or they'll call it fringe benefits, but it's basically your payroll taxes, your leave like vacation, sick, and holiday, and your benefits, which would be the company paid portion of your benefits, like if the company pays life insurance on everybody, or the company pays 30% of the health insurance premium, things like that, benefits. Overhead is the support cost for operations. If we go back to my Honda dealer example, the support cost for the operations is everything they need to do technically to repair my car, which is they've got the parts catalog, they've got the systems, they've got the location, they've got the bays and all that. That's overhead because they can't fix my car if they don't have those things. But G&A is kind of the headquarters or support costs that they do. So the customer service reps in that case, and the cost of the Honda billing system would be part of G&A. So there's these three categories. Sometimes I just tell people to remember it's FOG, fringe, overhead, and G&A. And I'd like you to always remember it in that exact order because that's the order in which these costs get applied. Yesterday, I also mentioned something that is unique to government contracting called unallowable cost. These are costs where the government says, okay, you're going to have those costs, but you're going to pay for them out of your profit. You can't put it into our rates. You better not put it in a bid. If you do this wrong, there's penalties involved, but it's typically interest expense, alcohol, entertainment, first class airfare, lobbying, gifts, contributions, things that, as a taxpayer, I shouldn't pay for a company's cost of that. If they want to offer those things, they can certainly do it, but I'm not paying for their advertising. I'm not paying for billboards. I'm not paying for the cost of their fancy branding. All of those things are unallowable. Doesn't mean you can't spend it. Doesn't mean it's not tax deductible. It's just you can't include it in your price or your cost on government contracting. The other thing is, at the end of the day, whatever you bill minus these costs is what your profit is, right? Well, in the government contracting world, they don't usually use the word profit. They call it fee. These terms are interchangeable. And just be paying attention as you're responding to government contracts to know that when you see the word fee, it means profit. And when you're bidding, if they use the word fee, you should use the word fee. Okay, this is Jenny's roadmap just for you. It is what goes into the elements that I just described as fringe. I tell people, just as a rule of thumb, that fringe should be about 30%. And here's how I come up with that. Payroll taxes, and there's a list there on the right, so I'll go through that in just a minute. Payroll taxes, by the time you do Social Security and Medicare, plus state unemployment taxes, plus federal unemployment taxes, plus workers' comp, average across the board about 10%. Some places will be higher, some will be lower. And I'll tell you this, when we went through the recession several years ago, everybody that used to have state unemployment jacked up their rates and added extra benefits because they were having to support their employees or the people that were unemployed. And so they passed those costs on to employers by adding extra higher cost. But the other thing that comes into play here is what state or states are you doing business in? If you're working in southern states like Alabama, Georgia, Texas, Florida, Tennessee, Kentucky, those tend to be pretty lower cost states to do business with. But if you're in California, Hawaii, New Jersey, Massachusetts, Pennsylvania, Rhode Island, Washington State, you're going to find that the cost of doing business in those states are higher, and they do it through these state unemployment taxes, but they've renamed them in most cases to call them employee assessment taxes or different types of taxes. And they've done it not through legislative actions as much as they have by adding little fees that they can do. But if I were to add all those things up, and if I had to pick a number out of the air, it's going to be around 10%. You might get it to 9.5%. In some cases, it'll be higher, but just know it's going to run about 10%. So if you're bidding 5% element for payroll taxes, you're going to lose. You're going to lose money because you haven't covered everything. Let's go to the second element, leave. As a general rule, most government contractors over time, and this I need to update actually, is they'll say, okay, we just hired somebody. We're going to give you 10 holidays a year. We're going to give you 10 days of paid leave or vacation, annual leave, whatever they paid time off, whatever they call it. And we're going to give you 40 hours of sick leave. That is roughly 80 plus 80 plus 40 is 200 hours, right? 200 hours a year. Well, 200 hours divided by 2,080 hours in a year, which is what, 52 weeks at 40 hours a week, about 10%. This number of 10% is actually a little bit higher for two reasons. One is we now have new federal holidays, so we have 88 federal holidays a year. And in general, most companies these days are bidding 88, but they are also looking for direction when they're bidding with a contract to find out if they're required to bid 88 or if they can do less. But you certainly don't want your proposal chunked because you bid 80 and it should have been 88, and you don't want to lose on price because you bid 88 and everybody else bid 80 and got away with it. Okay. The second thing that's going on is there are certain contracts covered by something called the Service Contract Act, and they call this SCA. And there's also, they have something called executive order sick leave. During the Obama administration, President Obama signed an executive order where he said, if you got this kind of contract, you must offer 56 hours of paid sick leave per year. There are also sometimes state rules about how much sick leave you need to offer. I would definitely check if you're doing business in California. I'm not sure what other states are there, but you do need to do some research, and you can usually do it online. I usually go to ADP's website when I have questions like that, because ADP is a big payroll company and they keep up with it. But you should be able to Google requirements by state or employer requirements by state, and it'll have it. The other thing I did want to add is a lot of people do combine vacation and sick and call it paid time off or PTO. That's kind of good and kind of bad. Typically, when people terminate, you don't owe them unused sick leave. But when they terminate, you owe them unused vacation or paid time off. So just keep that in mind when you're looking at your benefits. Get some advice from some other people on what you want your benefits plan to be and understand what it is. And when you're starting off, you don't have all these things, so you really don't know what to do. But eventually, if you're going to be successful in government contracting, you're going to have a handbook, a policy manual, all of these kind of things. And you'll be taking segments of that and putting them into your proposal, because they will ask you in your proposal, what are your policies? Are you taking care of employees? The next element we want to take a look at is group benefits. Okay, so group benefits are medical insurance, dental insurance, life insurance, which is usually combined with AD&D, which is accidental death and dismemberment insurance. So we've also got some other benefit programs, such as a Section 125 cafeteria plan, where the employees can choose dependent care, medical reimbursement, things like that. That actually doesn't affect your pricing, but I put it on here for a specific reason. If you're going to be successful in government contracting, you've got to be moving your company toward the point where you can add these benefits, or else nobody's going to work for you because you're not offering competitive benefits programs. And you also could find yourself not being able to attract employees. And that's one of the number one things that people are struggling with these days, is recruiting employees, getting them to come to work and having them stay on board, because retention is a big issue, especially in government contracting, because there's always a downward pressure on the rates. The government doesn't want to pay for it, but how do we keep good people if we can't put it under our pricing? Optional insurance that's 100% employee paid is not a company expense. Example of that would be Aflac. But here's the deal. When you're designing your benefit package and you're trying to attract people to come work to your company, they're going to ask you, how much is my health insurance premium going to be? And it used to be that people would go, well, listen, we're just super generous and we're going to pay 100% of all the employees' medical insurance, and we're going to pay 50% of the family insurance. Well, and we're going to offer dental insurance and we're going to pay 100% of that because we want benefits like that for ourselves as the owner. Well, these things have really gotten tight over the last several years, especially as we went through COVID, and we still have rising costs for health insurance all the way across the board, especially impacting small business. So you're going to find that this is going to be a very strategic decision for you as a company, and you really want to think about it as you're moving forward, because each time that you cross kind of a threshold as a company in the size of the company, which I usually measure by what your headcount is, it's going to be one thing when you're under 10 employees. It's going to be another thing when you're 10 to 25, over 25 to 50. And when you get up to 50 employees, there's rules that you have to report more stuff to the federal government. It's going to apply more cost. So I've even seen companies that will deliberately stay at 49 employees for that specific reason. There are other components that some people will have that'll be in fringe benefits. Some people put bonuses in fringe, and that might be a minor amount of money. Other people will put their bonuses elsewhere, and some people do offer tuition reimbursement. But when you're being evaluated on a proposal that's competitive, You've got to look at what your competitors are offering and say, well, we may not have that now. If we were to win that, we need to know what that would be and what it would cost. Let me go on to the next one. What goes into overhead and what goes into G&A? I get asked this question all the time because it's confusing. I mean, these are new terms you haven't heard for a while. And all I can really say is when you're trying to decide about overhead and G&A, sometimes I find it's better to say what goes into G&A and what goes into Fringe, and overhead's everything that's not in those two places. So let's start here with G&A. G&A is your corporate expense. It's the cost of running the business. It's the staff for your activities for the executive functions of running the company, like CEO and COO, the accounting, human resources, plus their fringe and their office space. There'll also be things that are unique to the company that only get paid at the company level. Your state and local taxes, taxes and licenses, property taxes, your insurance as far as general liability insurance, professional liability insurance, things like that. Your legal expenses, having to consult with attorneys on labor law and help have them draft for you consulting and NDA agreements. Professional might be accounting and auditing services. It could be consulting services that are specific to the corporation itself. And banking, you're going to have banking relationships. You're going to have banking fees. You can't charge interest expense here, but you will have service charges on banks, credit card processing, things like that. The other thing I put down here is be sure to exclude unallowable costs such as interest expense contributions, which are in the section, in another section we'll go over. So you've got to be able to basically make a list of all your costs, group them in a consistent manner, and say which one goes into which bucket, which is a lot of detail. So let me back up one then to this whole thing of overhead. Overhead is the cost of the technical support you need to provide the services that you as a company are uniquely capable of providing. So it's the support required for the technical workforce. Over the past many years, we spend a lot more on recruiting technical people. We've got all the things that you do to find employees, whether it's Indeed or USA Clearance.jobs, or whatever those things are. We've got a lot more recruiting cost to get people onboarded and to identify. We've got resume databases we have to keep up with, all kinds of stuff like that. But it's also if those people need training, if they need software, if there's professional development or technical dues, there's all kinds of costs like that. And if you're running equipment or labs, support costs, those costs are also part of your overhead, which is why I said, I think in yesterday's, that overhead varies by company and by the kind of work you're doing. There are companies that only work by providing people working in a government facility. That kind of work is called professional services or staff augmentation. But the buzzword in the industry is called butts in seats, which means all you're doing is you're providing somebody like a temp agency would to sit in Washington, D.C. in the Department of Commerce building on the 4th floor doing reviews of documents for export, for example. And so those people that are sitting there would have been government employees, but instead the government put it on a federal contract because it's a lot easier to cancel a contract than it is to lay off a federal employee. So when you have a situation where your people are being provided at a government facility, you have no facility cost. You're really doing very little support for them other than providing them an internet service, an email, and a paycheck. And so usually the overhead on that's really low. The other reason I wanted to bring this up that I covered a little bit yesterday is there are terms in government contracting that will say on-site and off-site. Some people say on-site is when I'm doing work at the Department of Commerce facility. And so that bid should not include the facility cost. It should be pretty low. And other people will say, no, on-site's when they're working at my office and I include the facility. So you really need to read when you see the terms on-site and off-site, make sure you understand whether they're defining that as working in your facility or working at a government provided facility. Because if you get them flipped, you'll either win the contract and lose a ton of money because you bid them backwards, or you won't win the contract because you just misunderstood and they could tell from the way you wrote it up that you didn't have a clue of what you're doing. These days, what I tell people to do is please start calling that client site and company site to make it clear, but people use it interchangeably and different people flip them back and forth. So don't assume that it's a standard term. Read that through and make sure you're doing that, identifying that correctly. I also want to point out that there's some gray areas that could be either in overhead or G&A, depending on your business structure and your strategy. Here's one that comes up a lot: a facility security officer. If you're doing work where you have a facility security clearance, or you're doing work where you have employees that maintain some level of security clearance, usually there's an administrator, somebody in the company, it could be the chief executive or the owner of the company, that operates as a facility security officer. Once you get to the point where that's like a part-time or full-time job, you might want to say, well, the only reason I have this person is because we have contracts that have that, and then you'd want to put it in overhead because it's really a cost of performing on the contract, but you can't charge it as direct to the contract because that FSO or facility security officer supports a bunch of contracts. Sometimes there's a section of your company that's called program control that does the reporting on contracts, because as we've matured in federal contracting, they're always looking for the contractor to do more and more reports. And it used to be we would put that in corporate or G&A function because it was an accounting function. But now what we're finding is many times they'll have such extensive reporting on a contract. They want this monthly report. We want you to prove that you're doing this. We want you to show that you've got these deliverables, things like that. That it's almost like we have people that do nothing but that, and we move those to contracts to be overhead. The other thing is, mathematically, if you have a choice, you want to put something in overhead instead of G&A, or your G&A rate's going to go through the roof and you won't win any business. Let me give you an example of G&A that applies in the real world. Let's say there was a natural disaster and I want to contribute. Should I give my money to Red Cross, Salvation Army, a local group that's going to do something? Well, what I want to know is if I give $100 contribution, how much of that money is actually going to go to the people that I want it to get to? Because some of these organizations take a cut off the top. It's called G&A or corporate expense. And maybe with the Red Cross, it's 10% off the top. Maybe with Salvation Army, it's 5%. If I want to get my $100 to have the most value to the people I'm trying to send it to, I'm going to give it to Red Cross because they're going to take $5 off the top, give the other 95 to the actual cause I'm trying to contribute. So there's this big thing on Charity Navigator, and it evaluates that kind of stuff. So you want to take a look at what you're doing. It's the same thing in government contracting. If I've got two companies coming to me and they have priced out this contract, and one of them has a 10% G&A rate and the other one has a 12% G&A rate, and their pricing is about the same, sometimes I don't have another way to make a decision. I'm just going to say, I'm going to go with these guys who are 10% G&A because I think it'll be cheaper in the long run. Not all of the decisions that are made are totally logical, and you really don't have a way you can influence that decision because you're sending off your bid quietly for them to evaluate, and you don't have any interaction. Okay, let's talk about how indirect rates are calculated. Indirect rates are calculated based on the actuals you have off your income statement, your budget, your estimate, or your forecast. They're calculated over the calendar year for most businesses. So as we're sitting here talking, it's about September, and people ask me, well, my indirect rates seem really high. And what I tell them is, well, I think they'll go down by the time we get to December. I'm going to take where you are now, plus your budget for where you're going to be between now and the end of the year, and do an analysis if our indirect rates are going to come down. Because guess what? We just started a new contract and it added, I don't know, 20 people. That's going to make our indirect rate ratio go down. And it's really like this. As your company grows, it's an economy of scale. If I have the same staff running the business and I add a new contract, that means I have more base, more revenue to spread those costs over, makes every cost per unit cheaper. So the same way, if we go back to the Honda place, if they have 10 cars a day, they can spread their cost over those 10 cars. But if they have 100 cars a day, they can spread those costs over more. So it's just a kind of a per unit thing. Many times on these contracts that you're bidding, your proposals, you're asked to forecast for future years. I just want to point out that it is really hard for a small business to forecast, 3 years out, much less 5 or 10 years out. And all you can really do, in my personal opinion, is estimate that it'll be about the same 2 or 3 years out. Because as a small business, if you can see 6 months out, you're doing great. But many times I see a kind of a trap that you're asked to forecast for future years, and you just feel like, I don't know where I'd come up with that. And you're not alone. It's really hard to come up with that. And you just need to say, we did an estimate that our rate, we would maintain our rates over the next 3 or 4 years. Here's the math of how we do fringe calculations. It is your payroll costs associated with payroll employees, their payroll taxes, their leave, and their group benefits, divided by what I call productive labor. Productive labor is the labor when they're working. It does not include vacation, sick, and holiday, because that's up in there where it says leave. So it's a percentage. As I mentioned, it'll roughly be 30%, but you'll need to calculate it. And down at the bottom on this, I just put, this is the most common calculation method, but there are other methods. So sometimes you'll work with a prime contractor. They show you a different method and they want you to do it that way. You don't want to change your method with every single new customer. You pretty much want to design and understand what it is, but sometimes you'll have to bid slightly differently. But in the end, mathematically, it should come out to the same, theoretically. But many times I see people goof that up. Okay. Our indirect calculations, our overhead is typically your overhead costs divided by direct labor. And that direct labor is the direct labor worked on contracts. It's usually your overhead labor would be, let's pretend that you had a recruiter and a facility security officer. They might be your overhead labor. And you'd also take, well, their work, we have to apply the 30% fringe. Our other overhead labor might be the fees that we're paying for our online recruiting systems and, monster.com and those kind of things. And then there's also, if they're working in your facility, there'd be some facility allocation, and that would be your calculations. Okay, the next one, let's take a look at G&A. G&A is all of your corporate expenses divided by what's called total cost input. That's your direct labor, if you have direct travel, direct materials, direct subs, direct consultants. And by all of those, they would have to be charged to a contract. And there's also overhead that's applied to direct labor that goes into that bid. And I'm going to show you some math examples here in a minute to try to help. But I came up with this list many years ago when I started a new job, and I had told my boss that I understood all this stuff, and I did, but I never had to apply it. And so there's a report that came out of our accounting software that did these calculations, and I basically created myself a map and have memorized it over time and refined it for you to try to give you some guidance on what it is. Earlier, I mentioned what's called a typical government contractor income statement. And in yesterday's call, I even talked a little bit about if you send me your income statement and if I see one line that says salary and wages and it's not broken out into direct labor, overhead labor, G&A labor, and so forth, you've already failed the DCAA compliance piece, then you just kind of need to know it has to be broken out. Now, I simplified these examples, and so I don't have direct labor, overhead labor, G&A labor. I kind of lumped them all together. And I did this because I wanted to give you a super simplified mathematical example. So if I have 10 million in revenue, 50% of that might be direct labor for $5 million. I'm going to apply 30% fringe, which is 30% times $5 million is $1.5 million. I'm going to charge 38.35% for overhead, and that's 1917.50, which is 38.35 times the 5 million. 10% for G&A is on the 5 million, the 1.5, and the 1.9. And then my profit is 8%, just as an example. And I did this for a specific reason because these rates would actually be too high to win anything. I'll go into that a little bit more. Okay, so if you look at this screen and I go to the next one, what I want to say to you is these indirect costs are like taxes. The green stuff on the left is what your customer wants. They want you to provide the people to perform the work they've asked you to. And as far as they're concerned, everything else is tax. So you want to make sure that your taxes provide good service and are not unreasonably high, or you won't win. So another way that I express this is I've already mentioned that our indirect rates and pools, 30% for fringe, overhead just depends on the kind of work you're doing, and our G&A. Fee is an interesting animal. People are always surprised when I tell them, if you make 5 or 10% in government contracting after you paid all your costs and everything else, you're doing good. If you're going into a business to make a ton of profit, you may not want to go into government contracting because it's one of the most highly regulated businesses in the world. And because you're competing all the time on price, the profit's not very high. The reason people go into government contracting is because they're attached to the mission, or they like the idea of bidding for work that can be 3 to 5 to 10-year contracts, and that's stability. Or they've been in it so long, they're just super good at it, right? But anyway, you will not see a government contract where your profit rate's going to be 12 to 15%. And because in many cases you have to reveal what profit percent you put in. If you put in a profit percent that's high, it's either going to get cut back, or they're going to say their total overall bid was way too high. We're just knocking them out of competition. We're not even going to do anything more. So I'm going to talk to you about this concept of a multiplier or a wrap rate. A multiplier or wrap rate is the amount you multiply your direct labor rate by to get a billing rate that covers all your cost per profit, and it's based on your income statement actuals and projected cost. When you're early in your stage of growth with a government contractor, what you pretty much do is you figure out what it ought to be, and that's what you bid. Because if you were to bid too high, you'll never win any work, and you're never going to get any stability in your company. And usually it takes until you get to about 10 employees before you do have that stability. So in your early years, what you want to do is figure out what you can do to get about 10 people on board, because until then, you're just going to be, always in that up and down cycle. Remember that income statement that I showed you just a few minutes ago? We're going to use these same percentages to determine how much you burden. And burden is just that's just a accounting term for how much stuff you put on top of your direct labor. And they'll call this a multiplier or a burden. And you can see I've used the same percentages, and I just did it so it could be simplified. I took $1 worth of direct labor, and I used those same percentages, 30, 38.5, 10%, and 8. that gives me a labor multiplier of 2.0. So what that means is if I hire somebody for $50 an hour, in order to cover all my indirect costs, which is fringe, overhead, G&A, and the profit, I've got to charge for that $50 an hour person. I've got to multiply it by 2. So I have to charge $100 an hour. Well, what I wanted to point out is that was the way it was in the Reagan years. And you pretty much, there's no way you'd win contracts at this rate anymore. That was true years ago. And I just did it to give you an example so you could understand mathematically how this calculation works. If $50 an hour at this multiplier of 2 means that I got to charge basically 200% to cover all my costs. So it would be $100 an hour. Don't use these. These are too high. These days, when you're providing staffing at a customer site, it would be more logical to have a bid rate or a multiplier of about 1.5. And here's how I came up with it. 30% for fringe, 3% for overhead, because you're hardly providing anything but internet service, some recruiting costs, some supervision, those type of costs. Your G&A, I pulled a really low G&A rate of 8%, could be 10%, could be higher, and a profit of 7%. So in this situation, I take $50 an hour times 1.5, and that's somewhere around $75 an hour. But you'll start to listen as you grow into government contracting. They'll say, what's your up rate? What's your multiplier? People use these terms interchangeably, and you just need to be paying attention to which one they mean when, and say, well, we're all going after a 1.45 rate. Well, that means you're going to have to be lower on a fringe or lower on overhead or lower on profit if this number is going to come down. Mathematically, we know that. Here's a billing rate using those calculations. So I have like a little wrap rate calculator that in Excel that you can basically use this as an example and put your own. But I like to tell people to have one of these sitting on their desktop so that anytime somebody walks in and says, well, I heard we can charge $75 an hour for this position, and you know what your actual fringe, overhead, and G&A percentages are, then you can direct that person, okay, but you can't pay that person over $48 an hour or whatever it comes